Before we begin, a quick and important disclaimer. The content provided in this video is strictly for educational and entertainment purposes only and does not constitute professional financial, legal, insurance, or investment advice. The intersection of macroeconomic data, family law, and theoretical insurance products is highly complex and involves significant variables that are deeply personal and legally binding. We are analyzing historical trends, economic indicators, and potential market outcomes, not offering a solicitation for any specific financial product or a blueprint for your personal wealth management. Any discussion regarding asset protection, risk mitigation, or legal strategy is entirely theoretical. Viewers must conduct their own extensive due diligence and consult with licensed professionals, including certified financial planners, family law attorneys, and registered insurance brokers, before making any decisions regarding their personal financial situations, marital contracts, or asset allocation. The economic landscapes and market trends discussed are subject to rapid change based on Federal Reserve policies, legislative shifts, and global market dynamics, meaning past performance or historical data analysis is never an indicator of future results. Imagine dedicating a decade of your life to building a robust, diversified financial portfolio. You have diligently contributed to your retirement accounts, navigated the volatile housing market to secure a property at a favorable interest rate, and maintained a pristine credit score. Now imagine a single life event completely outside of traditional market fluctuations, an event that instantly legally mandates the liquidation of those hard-earned assets, forces the sale of your home in a potentially unfavorable market, and triggers catastrophic tax liabilities and legal fees that can easily surpass the median annual household income in the United States. You do not have to imagine this scenario, because it is the statistical reality for millions of Americans. We live in a society where we are aggressively conditioned to insure our assets against almost every conceivable threat. We purchase homeowners insurance to protect against fires that have a fraction of a percent chance of occurring in any given year. We carry comprehensive auto insurance to shield us from the financial ruin of collisions. We buy health insurance, life insurance, and even specialized policies for our cell phones and household appliances. Yet, the single greatest threat to the average American's net worth, an event that historical trends suggest will impact nearly 40 to 50% of all marriages, is left entirely uninsured. The wealth destruction associated with marital dissolution is staggering. Case studies in household economics frequently demonstrate that individual wealth can drop by as much as 77% following a divorce. The underlying mechanics of this financial devastation are not merely the cost of attorneys, though a contested legal battle can easily drain tens of thousands of dollars. The true devastation lies in the forced untangling of integrated financial systems. Consider the modern American economic landscape, which heavily incentivizes and often requires the dual-income household just to achieve baseline middle-class stability. The median home price in the United States has reached levels where qualifying for a mortgage is increasingly difficult on a single income, especially in an environment defined by historically elevated interest rates. When a marriage dissolves, the economic efficiency of that household instantly vanishes. One household bearing one set of utility bills, one property tax payment, and one mortgage suddenly splits, requiring the same pool of capital to fund two entirely separate, increasingly expensive lives. The marital home, often the crown jewel of the couple's net worth, usually must be sold so the equity can be divided. If this forced sale occurs during a market downturn or a period of high mortgage rates, years of accumulated equity can be wiped out instantly by market conditions, realtor commissions, and capital gains taxes. Retirement accounts, built over decades with the assumption of long-term compound growth, are routinely subjected to qualified domestic relations orders, slicing them in half and destroying their future compounding potential. This brings us to a massive, glaring inefficiency in the global financial markets. If actuaries can accurately price the risk of hurricanes, corporate defaults, and global pandemics, why is there no mainstream institutional-grade financial product designed to hedge against the catastrophic wealth destruction of divorce? The concept of divorce insurance is not entirely new. It has been whispered about in financial technology circles and attempted by niche startups in the past. However, these early iterations historically failed due to a fundamental principle in the insurance industry known as moral hazard. Actuaries feared that if you provide a financial safety net for divorce, you might inadvertently incentivize the very behavior you are insuring against. If a policy pays out $50,000 upon the dissolution of a marriage, human nature and economic pressure might push a struggling couple toward the courthouse rather than the counselor's office. But something fundamental is shifting beneath the surface of the United States economy. The data is changing, and the macro environment is evolving in a way that is quietly forcing financial institutions and risk analysts to revisit this multi-billion-dollar market gap. We are witnessing a unique convergence of macroeconomic pressures: persistent inflation squeezing dual-income households, an unprecedented lock-in effect in the housing market where couples cannot afford to move due to trapped low-interest mortgages, and a generational shift in how millennials and Gen Z approach marriage, prenuptial agreements, and financial autonomy. In this comprehensive deep dive, we are going to unpack the specific U.S. economic data points that suggest the market is finally ripe for the institutionalization of divorce insurance. We are not talking about fringe theories. We are going to analyze the labor market participation rates, consumer price index trends, and household debt-to-income ratios that are fundamentally altering the financial risk profile of the American family. We will explore the actuarial science behind pricing human behavior and how modern data analytics, artificial intelligence, and sophisticated predictive modeling could theoretically solve the moral hazard problem that plagued earlier iterations of this concept. For the average American investor, taxpayer, and participant in the modern economy, understanding this potential market evolution is critical. Whether you are currently married, planning to combine finances in the future, or simply a student of market trends looking for the next massive disruption in the financial services sector, this analysis will equip you with a profound understanding of how macroeconomic forces are quietly reshaping the most intimate financial contracts of our lives. We will examine the potential outcomes of a market where relationship risk is commodified, how such a product could stabilize the broader housing and consumer credit markets by preventing sudden waves of distressed debt, and what the historical data tells us about the feasibility of underwriting the ultimate human variable. The financial architecture of the American household is under unprecedented stress, and the market always responds to a demand for risk mitigation. The data is hiding in plain sight, and it is time to analyze exactly what it is telling us about the future of household financial protection. To understand why the financial sector is quietly obsessing over this concept in 2026, we have to look at the unprecedented trap the modern American middle class has fallen into. The traditional safety nets are gone, replaced by structural economic vulnerabilities that amplify the financial destruction of a split. Imagine a typical couple, let us call them David and Emily, living in suburban Atlanta. In 2021, they secured a standard 30-year fixed mortgage on their marital home at a historical low interest rate of 2.9%. Fast forward to our current economic reality in 2026. The national average for a 30-year fixed mortgage has stabilized at a significantly higher plateau, hovering around 6.8%. David and Emily decide their marriage is irreparably broken and file for divorce. Historically, the standard procedure for dividing this massive asset was straightforward. The couple would sell the marital home, divide the accumulated equity evenly, and use those proceeds as down payments on two new, separate properties. But the 2026 macroeconomic environment turns this standard procedure into a mathematically devastating maneuver. If they sell the property, they permanently surrender that incredibly valuable 2.9% interest rate. Taking their half of the equity to purchase a smaller home at nearly 7% means their individual monthly housing costs will skyrocket, often exceeding their previously combined mortgage payment. They are economically trapped in the same physical structure because the cost of capital has fundamentally shifted against them. Economists refer to this phenomenon as the mortgage rate lock-in effect, and it is weaponizing the divorce process across the country. Instead of a clean legal break, couples are forced into highly volatile, protracted cohabitation agreements purely out of financial necessity. Alternatively, one spouse is forced to assume crippling, high-interest debt to buy the other out at current market valuations and current interest rates. The Federal Reserve data on consumer debt profiles paints an even bleaker picture of this transitional phase. Over the past 4 years, we have seen persistent, sticky inflation deeply erode the purchasing power of the median household income. Savings rates have plummeted from their previous highs to near historic lows. When the dual income efficiency of a marriage is shattered by divorce, the newly formed single households are immediately hit with a sudden, massive liquidity crisis. Legal retainers, mandatory financial mediation, discovery fees, moving expenses, and the sheer cost of outfitting a second household require tens of thousands of dollars in liquid cash. The average American simply does not possess this level of extreme liquidity. This absolute necessity forces a rapid accumulation of high-interest unsecured consumer debt. Credit card balances swell, and personal loans are taken out at double-digit interest rates just to facilitate the legal and physical separation. The wealth destruction begins long before the judge even signs the final divorce decree. Let us pivot to another devastating financial vector: the systematic dismantling of long-term investment portfolios. Consider Michael, a 45-year-old software engineer residing in Austin, Texas. He has diligently contributed to his retirement accounts for 20 years, riding the bull markets and surviving the painful market corrections. His portfolio is structurally designed to compound uninterrupted until his late 60s. Upon divorce, his ex-spouse is legally entitled to a significant portion of those marital assets. This division is typically executed through a legal mechanism known as a qualified domestic relations order. While this order allows the transfer of funds without immediate early withdrawal tax penalties, the long-term macroeconomic damage to the individual is catastrophic. By instantly having the principal balance of the portfolio, the account loses its most powerful economic engine, which is the compounding effect on a massive capital base. To ever reach his original retirement trajectory, Michael cannot simply double his monthly contributions. The unforgiving math of compound interest dictates he would need to contribute exponentially more capital during his remaining working years. This is a mathematical impossibility given his new, significantly higher cost of living as a single adult managing his own isolated expenses. He has suffered a permanent, unrecoverable reduction in his lifetime net worth. Now, imagine if the free market had a mechanism to absorb this initial shock. Imagine a theoretical financial product, a relationship stabilization policy, structured similarly to a term life or severe disability insurance policy. If a triggering event occurs, such as a formal legal separation or the filing of divorce papers, the policy triggers a defined liquidity event. A lump sum payout of $50,000 or $100,000 is deployed directly to the insured parties. This is not a lottery windfall. It is a carefully calculated economic buffer. This capital is specifically designated to cover the immediate transitional costs. It pays the hefty legal retainers, funds the first and last month's rent for the departing spouse, and covers the immediate family therapy and child transition costs. By injecting targeted liquidity at the exact moment of maximum financial vulnerability, the policy prevents the forced fire sale of illiquid assets. David and Emily do not have to panic sell their artificially cheap mortgage in a high-interest rate environment. Michael does not have to liquidate his tech stocks during a market dip to pay his divorce attorney. The secondary economic effects of this stabilization are massive and systemic. Foreclosure rates directly linked to marital dissolution would plummet across the housing sector. The sudden spikes in consumer credit defaults and subsequent bankruptcies that frequently follow a complex divorce would be heavily mitigated. From a broad macroeconomic perspective, an entire class of distressed debt could be systematically eliminated from the banking system. Financial institutions would see lower default rates on their existing consumer loan portfolios, making the broader consumer credit market significantly more resilient to localized economic shocks. Let us dive even deeper into the historical trends that make this hypothetical product so relevant today. In previous decades, the financial gap between the primary breadwinner and the secondary earner or dedicated homemaker was heavily pronounced. Long-term alimony or permanent spousal support was the primary legal mechanism for smoothing the financial transition of the lesser-earning spouse. However, labor market participation data in 2026 definitively shows that the dual professional household is the absolute standard model in urban and suburban America. Because incomes are more closely balanced, family courts are increasingly reluctant to award long-term alimony. The modern judicial expectation is that both parties will be entirely financially independent shortly after the split. But this legal shift completely ignores the immediate, crushing need for transactional capital to actually execute the split. The legal system has evolved to treat marriage as a purely economic partnership that can be dissolved at will, but the financial products available to the general public have completely failed to evolve to ensure the complex dissolution of that partnership. Think about the fundamental concept of business interruption insurance in the corporate world. When a manufacturing facility is struck by a natural disaster, the insurance policy does not just pay to rebuild the physical walls. It actively replaces the lost revenue while the business is non-operational. A modern household is a highly complex economic enterprise. It produces joint income, manages shared debt, and invests combined capital. Divorce is the ultimate household business interruption. A specialized insurance product would act as a critical bridge loan, keeping the economic enterprise solvent while it is painfully restructuring into two separate, smaller enterprises. The potential outcomes of widespread adoption of such a product would fundamentally reshape personal finance. Professional financial planners would begin to incorporate relationship risk into their standard portfolio stress tests, alongside inflation and market volatility. Prenuptial agreements would evolve from adversarial, defensive legal documents into collaborative financial planning sessions, where the insurance policy premiums and coverage limits are negotiated alongside standard asset division. But here is where the entire theoretical framework collides with the brutal, unforgiving reality of actuarial science and human behavior. If a massive financial institution creates a mainstream product that pays you $100,000 in cash when your marriage fails, how do they mathematically stop you from faking the failure? How do you prevent a severely financially stressed couple from legally divorcing just to claim the massive payout, only to continue living together in secret to pay off their debts? This is the billion-dollar question holding back the entire industry. It is a concept known in economics as moral hazard, and it is the ultimate nightmare scenario for any corporate risk analyst. To make this multi-billion-dollar market work, actuaries cannot just look at historical spreadsheets. They have to actively predict and quantify human deception. And as we will see in the next phase of our analysis, the insurance industry is quietly developing surveillance and data tracking protocols that could completely eliminate this risk, utilizing private data in ways that will fundamentally shock you. The modern insurance industry has already trained the public to accept a remarkable degree of behavioral surveillance in exchange for reduced financial risk. If you want a cheaper auto insurance premium in 2026, you willingly install a telematics tracking beacon in your vehicle or download a smartphone application that aggressively monitors your braking patterns, your acceleration speed, and the exact times of day you choose to drive. If you want discounted life insurance, you grant underwriters access to your wearable fitness trackers, providing them with a real-time stream of your resting heart rate and daily physical activity. To solve the ultimate moral hazard of divorce insurance, the financial sector is simply applying this established telematics framework to your household financial data. We are moving from tracking physical velocity to tracking financial velocity. To understand how this operates in practice, imagine a married couple living in Chicago in 2026. Let us call them Kevin and Rachel. They are aware of a theoretical relationship stabilization policy that offers a $150,000 liquidity payout upon the finalization of a divorce decree. Facing significant credit card debt and an underwater auto loan, they decide to game the system. They legally file for divorce, endure the minimal waiting period, and submit their final paperwork to the insurance carrier to claim the massive cash infusion. Their secret plan is to use the payout to clear their debts, and then simply continue living together in their current home, maintaining their relationship off the official legal record. A decade ago, this type of sophisticated consumer fraud would have been incredibly difficult and prohibitively expensive for an insurance company to prove. It would have required hiring private investigators to physically monitor the property, a massive drain on corporate resources. But in the highly digitized economic landscape of 2026, human investigators are obsolete. Instead, the underwriting contract Kevin and Rachel signed specifically included a mandatory, read-only application programming interface integration with their primary financial institutions for a probationary period of 36 months post-payout. The insurance carrier's proprietary artificial intelligence does not need to look in their windows. It just looks at their ledger. The algorithm immediately flags highly anomalous post-divorce behavior. Despite being legally separated and claiming separate residences, Kevin and Rachel are still purchasing their groceries at the exact same geographic location, at the exact same time on Sunday afternoons. The geolocation data embedded in their individual smartphone operating systems, legally accessed through third-party data broker agreements buried deep within the policy terms of service, shows both devices consistently resting in the identical residential structure from midnight until 6 in the morning. Their separate streaming service accounts are logging in through the exact same Internet Protocol address and residential router. The machine learning models deployed by the insurance sector are trained to recognize the distinct financial fingerprint of a genuine household dissolution. When a real separation occurs, consumer spending patterns fracture entirely. You see the immediate activation of new utility accounts, the sudden geographical divergence of daily point-of-sale transactions, and a massive shift in the velocity of individual capital deployment. By analyzing millions of these localized data points, actuaries can build predictive models that identify synthetic divorces with near-perfect accuracy. Kevin and Rachel are automatically flagged by the fraud mitigation system, their payout is frozen, and they face severe civil and potentially criminal penalties. The moral hazard problem, the massive hurdle that previously prevented this product from existing, is systematically eradicated by the sheer volume of behavioral data generated by the modern American consumer. But this data integration goes far beyond simple post-claim fraud detection. It fundamentally revolutionizes how the risk is priced in the first place. How does an actuary determine the monthly premium for a marriage? They analyze leading macroeconomic and microeconomic indicators of marital distress. Let us look at historical trends in consumer credit. Case studies utilizing anonymized credit bureau data reveal a fascinating and terrifying pattern. In a stable household, the credit scores of married partners generally track together, moving up or down in rough unison based on joint financial decisions. However, a massive predictive indicator of an impending divorce is a sudden, sharp divergence in individual credit profiles. Imagine another scenario with a couple named Mark and Sarah. For 6 years, their credit scores have remained within 20 points of each other. Suddenly, over a 4-month period, Mark begins taking out high-interest personal loans and quietly maximizing the utilization limits on credit cards solely in his name, while Sarah's credit profile remains entirely stagnant. This rapid, localized accumulation of asymmetrical debt is a classic leading indicator of financial infidelity or preparation for a hostile split. If a divorce insurance underwriter has continuous algorithmic monitoring of these credit profiles, the policy can dynamically adjust. Just as your car insurance premium skyrockets if you get 2 speeding tickets in a month, the theoretical relationship stabilization premium would automatically increase as the system detects these high-risk financial behaviors. Furthermore, underwriters are heavily analyzing labor market data to price these policies. Historical trends demonstrate a strong correlation between sudden involuntary unemployment, particularly of the primary earner, and a sharp spike in marital dissolution rates within the subsequent 18 months. A highly sophisticated predictive model would factor in the specific industry the policyholders work in. In 2026, a couple where both partners are employed in highly volatile sectors like commercial real estate development or venture capital-backed technology startups would logically face a higher baseline premium than a couple employed as tenured university professors or municipal government workers. The risk profile is dynamically calculated based on the macro stability of their specific economic sector. You might be asking yourself why any rational consumer would willingly subject their private financial lives to this level of intense, algorithmic scrutiny. The answer is the exact same reason consumers allow tracking devices in their cars: the promise of massive financial leverage and premium reduction. An insurance company could offer 2 tiers of coverage. Tier 1 is a standard, non-monitored policy, but the actuary has to assume maximum risk, so the premium is an astronomical $800 a month. Tier 2 involves total financial telematics integration. By allowing the algorithm to verify your joint account stability, your geographic proximity, and your synchronized financial planning, the carrier can drastically lower their risk modeling. That same policy might now cost $150 a month. In an era where household budgets are stretched to their absolute breaking point, the American consumer has consistently shown a willingness to trade data privacy for economic relief. We have established that the macroeconomic need for this product is immense, driven by the housing trap and inflation, and we have established that the technological capability to underwrite the human element now exists through advanced behavioral data tracking. The structural foundation for a multi-billion-dollar disruption in personal finance is completely built. However, an insurance company is simply a risk aggregator. They do not actually hold the ultimate financial risk. If a massive economic recession triggers a sudden, localized spike in divorce rates across the country, a catastrophic wave of simultaneous claims could bankrupt the insurance carrier instantly. To make this market functional, that concentrated risk must be offloaded and sold to entities with pockets deep enough to absorb billions of dollars in sudden household trauma. The actual financial mechanics of how your marriage becomes a tradable asset on Wall Street involves incredibly complex derivative instruments, and the institutions currently positioning themselves to profit from this demographic shift are not who you think they are. When you hear the word insurance, your mind likely defaults to the massive retail carriers with the catchy television commercials, the companies that insure your sedans and your suburban homes. But those consumer-facing entities are merely the storefronts of a much larger, infinitely more complex global financial ecosystem. They are originators of risk, not the ultimate holders of it. If a retail insurance carrier were to underwrite 1 million relationship stabilization policies, a localized economic shock Perhaps the collapse of a major regional employer in the Midwest could trigger a sudden, concentrated spike in marital dissolutions. The resulting wave of simultaneous liquidity claims would obliterate the carrier's balance sheet overnight. To make this market functional and survive systemic stress, the risk of your marriage failing must be exported directly to Wall Street, repackaged into highly complex derivative instruments, and sold to institutional investors. The entities currently positioning themselves to absorb this demographic risk are institutional hedge funds, massive private equity syndicates, and even global pension funds. To understand why the apex predators of global finance want to buy the risk of your divorce, we must analyze a concept known as non-correlated yield. Imagine James, a senior portfolio manager at a major quantitative hedge fund operating out of Manhattan in the year 2026. James manages a $50 billion portfolio heavily exposed to the traditional equities market, corporate bonds, and commercial real estate. His primary terror is a macroeconomic contagion event, a scenario where inflation spikes, the Federal Reserve aggressively raises interest rates, the stock market crashes, and housing prices plummet simultaneously. In that traditional scenario, all of his traditional assets lose value at the exact same time because they are all deeply correlated to the central banking system. James is desperate for an asset class that generates a high, consistent return, but is completely divorced from the movements of the broader stock market or the bond market. He needs an investment that behaves independently of standard monetary policy. This is the exact financial void that demographic risk fills. The statistical probability of a marriage ending in the United States over a 10-year period is driven by deeply complex sociological, psychological, and localized economic factors. It is not directly correlated to a 75 basis point interest rate hike by the Federal Reserve. Therefore, if Wall Street can securitize relationship risk, they create the ultimate portfolio diversifier. The financial mechanics of this process are breathtaking in their complexity and closely mirror the architecture of catastrophic weather bonds used to insure against hurricanes. Let us walk through the step-by-step securitization pipeline. A retail insurance carrier originates 100,000 relationship stabilization policies across the United States. They pool these thousands of individual policies together into a massive specialized financial entity called a special purpose vehicle. This entity then issues bonds to institutional investors like James. These are not normal corporate bonds. We can refer to them as demographic yield obligations. When James purchases $100 million of these bonds for his fund, his money is placed into a secure collateral trust. As long as the national divorce rate among the insured pool remains below a highly specific, actuarially defined threshold, for example 42% over a 5-year period, James receives a massive quarterly interest payment funded directly by the monthly premiums paid by the couples holding the policies. However, if a severe societal shift occurs and the dissolution rate within that specific pool triggers above that 42% threshold, James loses a portion, or potentially all, of his initial $100 million principal. That principal is immediately unlocked from the trust and transferred down to the retail insurance carrier, providing them with the exact massive liquidity injection they need to pay out the sudden wave of divorce claims to the individual households. Wall Street never takes a blind gamble. They slice the risk into highly calibrated tiers known as tranches. The institutional demand for these tranches dictates the entire viability of the consumer product. A conservative state pension fund in California might purchase the senior tranche of this demographic bond. They accept a lower interest rate, perhaps 5%, but their principal is entirely safe unless the divorce rate in the United States hits an apocalyptic, historically unprecedented 60%. They are essentially buying an ironclad guarantee against societal collapse. Conversely, a highly aggressive, high-frequency trading firm in Chicago might purchase the equity tranche. They receive a staggering 15% yield, but their principal is wiped out if the divorce rate ticks up even half a percentage point above historical baseline averages. By structuring the risk this way, the investment banks can distribute the localized trauma of American household dissolution across the entire global financial system, diluting the risk until it is mathematically negligible to any single institution. This derivative market creates fascinating, almost surreal macroeconomic hedging opportunities for massive corporations. Consider the systemic risk of the housing market we analyzed earlier. A massive real estate investment trust holding 50,000 single-family rental homes in 2026 is deeply exposed to the risk of forced residential sales driving down neighborhood property valuations. If divorce rates spike, couples are forced to liquidate their marital homes, flooding the market with distressed inventory and crushing the investment trust's portfolio value. To protect themselves, this real estate trust would actively purchase the high-risk tranches of demographic yield obligations. It creates a perfect financial hedge. If marriages remain stable, their real estate portfolio appreciates in value. If marriages fail and flood the housing market with distressed properties, their real estate portfolio loses value, but their demographic bonds trigger a massive cash payout, entirely offsetting the real estate losses. They are using the actuarial science of human relationships to ensure their physical property assets. The creation of this secondary market is the critical catalyst. Without the hedge funds and the pension funds willing to buy the demographic bonds, the retail insurance carriers can never offer the underlying policy to the public. But now that the data infrastructure exists to monitor behavioral fraud, and the macroeconomic conditions of 2026 have created a desperate need for non-correlated asset classes on Wall Street, the pipeline is fully connected. Trillions of dollars in institutional capital are actively seeking a stable, yield-generating home, and the American household is the next great frontier for financialization. But when Wall Street connects billion-dollar financial outcomes to the stability of personal relationships, the dynamic fundamentally changes. If a massive private equity firm stands to lose $1 billion in principal if the divorce rate in a specific demographic rises by 2%, they are no longer passive observers of societal trends. They have a direct, overwhelming financial incentive to ensure those marriages do not fail, and the methods they could theoretically deploy to artificially engineer marital stability represent the most chilling intersection of corporate finance and personal autonomy in modern economic history. Imagine a scenario in 2026 where a massive private equity syndicate holds billions of dollars in demographic yield obligations. Their mathematical models show that if the marital dissolution rate in the American Midwest rises above 39%, their flagship fund will face catastrophic liquidity issues. They are no longer passive investors. They are highly incentivized stakeholders in the intimate lives of millions of Americans. To protect their principal, these financial institutions would logically deploy proactive, algorithmic defense mechanisms designed to engineer stability before the legal process of a split ever begins. We are talking about the weaponization of behavioral economics, funded by Wall Street and deployed directly into your household. Let us look at a highly specific case study to understand how this corporate intervention would function in reality. Consider a couple named Thomas and Jessica, residing in Columbus, Ohio. They hold a Tier 2, fully telematics integrated relationship stabilization policy, with a $200,000 payout upon dissolution. For 3 years, their data has been pristine. Their joint accounts show steady accumulation, their geolocation data confirms consistent physical proximity, and their individual credit scores are perfectly synchronized. However, the macroeconomic environment shifts. Thomas, a mid-level logistics manager, is unexpectedly laid off due to corporate restructuring. The insurance carrier's risk analysis algorithm, fundamentally tethered to the private equity firm's derivative risk threshold, detects the anomaly within 48 hours. The direct deposit into their joint checking account fails to materialize. Within 3 weeks, the algorithm detects a sharp, asymmetrical spike in credit card utilization solely under Thomas' name. Simultaneously, the smartphone geolocation data reveals a new, deeply concerning pattern. Thomas is consistently leaving the primary residence at irregular hours, and the time both devices spend resting in the same physical structure drops by 40%. The predictive model flags their household with a severe, immediate critical failure warning. Historically, this specific data pattern precedes a formal legal filing by less than 8 months. If this were a traditional, unmonitored financial product, the insurance company would simply prepare to absorb the $200,000 loss. But in the securitized ecosystem of 2026, the retail carrier and the institutional bondholders have aligned incentives to aggressively mitigate that loss. They execute an automated intervention protocol. This is not a human consultant reaching out. It is an entirely frictionless algorithmic deployment of capital. Jessica receives a secure notification through the insurance portal. It informs her that, due to their excellent standing and a newly unlocked premium tier, their policy now covers 6 months of elite, out-of-network clinical relationship therapy, fully subsidized with zero out-of-pocket costs. The financial mathematics driving this intervention are brutally pragmatic. The cost of funding premium, highly specialized conflict resolution therapy for 6 months might total $15,000. The cost of a triggered policy payout is $200,000, not including the systemic damage to the Wall Street bond tranche. By deploying $15,000 in targeted, proactive capital, the algorithm attempts to mathematically suppress the probability of the $200,000 catastrophic loss. They are effectively buying risk reduction. But the interventions do not stop at subsidized therapy. The algorithm understands that the root cause of the immediate marital stress is the sudden evaporation of liquidity due to Thomas losing his employment. Financial friction is the primary catalyst for the behavioral divergence. Therefore, the carrier initiates a secondary protocol, a temporary household stabilization grant. Thomas receives a notification offering a 0% interest microloan, or potentially even a non-recourse grant, specifically calibrated to cover their exact mortgage payment for 90 days. The messaging is meticulously crafted by behavioral psychologists. It is framed as an exclusive loyalty benefit, a temporary bridge loan to reward their years of consistent premium payments. In reality, it is a desperate corporate maneuver to prevent financial stress from shattering the legal contract of their marriage. This introduces a profound and deeply unsettling ethical paradigm. The couple believes they are receiving a benevolent customer service perk, completely unaware that a sophisticated artificial intelligence has calculated the precise breaking point of their relationship and is injecting the minimum viable amount of capital required to keep them legally bound together. The social safety net is being entirely privatized, not out of altruism, but to protect the yield of global pension funds and high-frequency trading firms. The theoretical capabilities of this ecosystem extend far beyond direct financial subsidies. When you consider the vast data broker networks operating in 2026, the potential for silent digital manipulation is staggering. The insurance carriers, acting as proxies for the institutional risk holders, could theoretically partner with major social media conglomerates and search engine providers. If Thomas and Jessica are flagged as a high-risk household, their individual digital environments could be subtly altered. The algorithms controlling their content feeds might begin suppressing media that normalizes or glorifies the single lifestyle, while artificially amplifying content that emphasizes family unity, the devastating macroeconomic consequences of dividing assets, and the long-term psychological toll of complex custody battles. They are trapped in a personalized, corporate-funded echo chamber, designed exclusively to maintain the structural integrity of their marriage. We are looking at the creation of synthetic marriages. These are households that, absent the aggressive financial and psychological intervention of their insurance provider, would have naturally dissolved. They are held together not by mutual affection or shared future goals, but by a complex web of corporate subsidies, zero-interest bridge loans, and algorithmic behavioral nudges. The couple becomes an asset on a balance sheet, artificially maintained to ensure a demographic bond does not default. This dynamic fundamentally rewrites the established rules of personal finance and individual autonomy. If a corporation can predict your dissolution before you even articulate the thought, and if that corporation possesses the financial leverage to alter your environment to prevent that outcome, the concept of free will within the modern American household becomes deeply blurred. The economic efficiency of the dual-income household is no longer just a necessity for the middle class. It is a vital, protected asset class for the global elite. But this unprecedented level of corporate intervention creates a massive, volatile pressure cooker. What happens when the underlying structural issues in the relationship are too severe for an algorithmic microloan to fix? What happens when the artificial stabilization protocols fail, and these heavily monitored, deeply indebted synthetic marriages finally implode in the legal system? The family courts of the United States are entirely unprepared for this new reality, and the upcoming legal battles over data privacy, corporate overreach, and the true definition of an equitable split are going to tear the judicial system apart. The collision between privatized algorithmic stabilization and public family law represents the next great earthquake in the American legal system. For decades, the courts have operated on the fundamental principle that marriage is a private contract between two individuals, largely insulated from third-party corporate interference. Family judges have held broad, discretionary authority to divide assets and determine support obligations based on equity, fairness, and the specific facts of each case. But how does that traditional judicial discretion function when the marital contract is no longer just between two people, but also includes a hidden third-party beneficiary, the global private equity firm holding the demographic yield obligations? Imagine a courtroom in 2026. A couple, let us call them Robert and Linda, are finalizing their divorce. They have been participants in a Tier 2 telematics integrated stabilization policy for 5 years. The insurance carrier, now a direct stakeholder in the financial outcome of this dissolution, intervenes in the legal process. Through a team of high-powered attorneys, the carrier petitions the court to introduce proprietary algorithmic data as evidence. They argue that the court's proposed division of assets would trigger a policy payout that violates the terms of their stabilization agreement. They are not merely observing the proceedings. They are actively shaping the legal outcome to protect their own balance sheet. This is not a theoretical fantasy. It is an inevitable extension of existing legal precedents. In various financial sectors, third-party administrators and lenders have long had the right to participate in legal proceedings to protect their interests in marital assets. If the insurance policy is technically a part of the marital estate, the carrier has a legitimate legal claim to represent its interests. The judge is suddenly faced with the nightmare scenario. On one hand, you have the traditional discretionary power to ensure an equitable split. On the other, you have a rigid, data-driven, contractually binding agreement that dictates exactly how the assets must be divided to prevent an insurance trigger. The algorithmic output, calculated by a black box model optimized for Wall Street yield, now sits on the bench alongside the judge, effectively demanding that the law conform to the mathematics of risk mitigation. The implications for data privacy are equally explosive. In a typical divorce, the discovery process involves the exchange of financial records. But what happens when that exchange includes years of granular, minute-by-minute behavioral data gathered by the insurance company? This is not just bank statements and tax returns. This is years of GPS logs, metadata from private communications, and biometric data from household devices, all of which the insurance company has been using to maintain the synthetic marriage. When this data enters the public legal record, the concept of marital privacy vanishes entirely. Every petty argument, every unauthorized purchase, and every deviation in daily routine, all tracked for the purpose of engineering stability, suddenly becomes public evidence in a hostile court battle. The insurance carrier, in its desperation to avoid a payout, could theoretically weaponize this massive, intimate dataset to paint one party as the sole cause of the household failure, thereby invalidating their claim to the policy. The judicial system in the United States is currently designed to resolve conflicts based on historical behavior. It is inherently reactive. The insurance stabilization model is fundamentally predictive and preventative. This creates a direct, irreconcilable friction. If a judge grants a standard, equitable divorce decree, but that decree forces a liquidity event that violates the complex, multi-layered risk model of the global bondholders, the insurance carrier will undoubtedly challenge the ruling. We are looking at the potential for a new category of litigation: algorithmic due process. We will see cases reaching the Supreme Court that ask whether a private corporate algorithm can legitimately constrain the discretionary power of a family court judge. Consider the case study of a family in Phoenix, Arizona, in 2026. Let us call them Marcus and Sarah. They have been fighting for 18 months. The insurance company has been proactively intervening, providing subsidized therapy and bridge loans to keep them together, because their policy payout would trigger a massive loss for a specific demographic bond fund. Eventually, the situation becomes untenable, and they file for divorce. The insurance company, having already spent $50,000 in failed stabilization efforts, now employs a strategy of scorched earth litigation. They present the court with thousands of pages of granular, telematics-generated evidence to prove that Marcus and Sarah violated the terms of their policy by failing to adhere to the behavioral milestones required for coverage. They argue that the policy is void, and therefore they owe nothing. The couple, already drained of their financial resources, now has to defend themselves against a multi-billion-dollar financial institution. The judge is trapped. If the judge follows the law and grants a fair, equitable divorce, the carrier loses millions. If the judge forces a settlement that keeps the policy active, they are essentially ruling in favor of a corporate mechanism that arguably coerces the parties to remain in a failed marriage. The judicial system is not equipped to handle this level of complexity. The courts are being transformed into a battleground between the fundamental rights of individuals to dissolve their partnerships and the contractual rights of global investors to protect their speculative yields. This leads us to a broader, more dangerous macroeconomic risk. What happens when the collective impact of these algorithmic interventions and legal battles starts to affect the stability of the entire society? If thousands of families are being held together by artificial financial constraints, if the family courts are being paralyzed by corporate legal interventions, and if the data privacy of millions is being sacrificed at the altar of demographic yield, the backlash could be catastrophic. We have been analyzing the economic data that supports this market, but we have yet to address the socio-political explosion that occurs when the American public realizes the most intimate contract of their lives has been commodified, securitized, and manipulated by the very institutions they hold responsible for their financial insecurity. The systemic risk is not just economic, it is institutional. As we move into the final phases of this deep dive, we have to look at the legislative reaction. Governments are already beginning to notice this trend, and the regulatory crackdown that is coming will fundamentally change the landscape of the entire financial industry in ways that could either stabilize this new market or destroy it entirely in a single, sweeping legislative motion. The question is, can the regulators move fast enough to contain the fallout? The legislative landscape in the United States, as we look at the trajectory through 2026, is fundamentally ill-equipped to address the collision between traditional family law and the hypermodern, algorithmic nature of speculative financial products. Historically, state insurance regulators have focused their oversight on solvency, fair market practices, and protecting consumers from catastrophic claims denial. They ensure that an insurance company has the capital reserves to pay out when a house burns down or a car is totaled. But the emergence of divorce insurance, coupled with the sophisticated securitization of household risk, forces regulators to confront questions that they have never had to answer. How do you regulate an insurance product where the primary goal is not just to compensate for a loss, but to actively influence the behavior of the insured to prevent that loss from occurring? Think about the regulatory pushback against telematics in the automotive insurance sector. When insurers first introduced devices to track driving behavior, there was immediate and fierce debate over data privacy and the potential for discriminatory pricing. That was a localized, relatively simple interaction. Now, imagine regulators attempting to apply those same oversight principles to the intimate data harvested from a household in 2026. The insurance carrier is not just tracking your physical speed. They are tracking your emotional and financial velocity. They are analyzing the stability of your relationships through the lens of credit utilization, purchasing patterns, and even geolocation data. State insurance commissioners are already struggling to keep pace with the rapid integration of artificial intelligence in core underwriting processes. When that AI is explicitly designed to maximize the yield of a demographic bond tranche by keeping a marriage legally intact, the traditional concept of consumer protection is effectively bypassed. The legislative response will likely take the form of aggressive state-level investigations into what is increasingly being called predatory behavioral underwriting. We are seeing early signs of this pressure from state attorneys general, who are beginning to scrutinize the role of private equity in the insurance sector. The primary concern is not just the privacy of the data, but the potential for systemic discrimination. If a predictive model determines that a specific neighborhood, or a specific occupational sector, is high risk for divorce and therefore qualifies for astronomical premiums or outright exclusion from coverage, are they creating a new form of digital redlining? This is a massive, unresolved legal question that could lead to sweeping bans on certain types of algorithmic predictive modeling in personal lines of insurance. Consider the potential for a landmark case in 2026 involving an insurance carrier that is forced to disclose the inner workings of its stabilization algorithm. If the discovery process in a court case reveals that the algorithm was programmed to ignore the warning signs of an abusive relationship to protect a demographic bond tranche from triggering a payout, the public backlash would be instantaneous and overwhelming. Legislators would be forced to act, likely by passing emergency protections that strictly prohibit insurance products from conditioning coverage on any metric that could be interpreted as influencing personal or marital behavior. Such a law would essentially decapitate the entire economic model of relationship stabilization insurance overnight. The impact on the consumer is equally complex. We have already established that many Americans are struggling in the 2026 economy, and the promise of a liquidity bridge during a transition is incredibly attractive. But at what cost? If the legislative environment shifts toward banning these products, the consumer is left without the very safety net they are desperately seeking. We are creating a situation where the market is providing a solution to a massive, systemic economic problem, but the regulatory framework required to make that solution ethical and sustainable simply does not exist. We are seeing a classic market failure where the regulatory lag is creating a vacuum that is being filled by innovative, yet deeply problematic financial engineering. The fundamental tension here is between the right of an individual to manage their own life and the right of an institutional investor to manage their own risk. If you are a couple in 2026 facing a devastating financial hit due to a divorce, You might be perfectly willing to sign away your data privacy and accept algorithmic nudges if it means securing the cash you need to survive. The regulatory system, however, is tasked with looking out for the broader collective interest, not just the individual decision. Legislators are worried about the long-term societal consequences of a population living in synthetic, corporate-managed relationships. They are concerned about the precedent of allowing private entities to exert influence over the core institutions of family and marriage. This legislative uncertainty creates a massive, looming risk for the Wall Street firms holding the demographic yield obligations. They are currently betting on a market that is not just financially profitable, but politically viable. If the legislative hammer drops, if a state passes a comprehensive data protection act that classifies marital behavioral data as sensitive, protected information, the entire securitization chain breaks. The value of those demographic bonds could evaporate in a matter of days. We are witnessing a high-stakes game of chicken between the most powerful financial institutions in the world and the state regulators who hold the power of law. The outcome will define the next decade of personal finance and digital privacy. But as we delve further, we have to recognize that the government is not just a regulator. It is also a participant. In our final phases, we will look at how federal agencies, desperate to stabilize the housing market and consumer credit, are actually quietly incentivizing these developments. The private sector is leading, but the public sector is silently clearing the path. The true architecture of this market involves a level of public-private cooperation that is much more extensive than even the most skeptical critics realize. How deep does this collaboration go? And what does it mean for the future of our individual autonomy? The answers lie in the hidden legislative riders and the subtle shifts in federal regulatory policy that have been occurring entirely under the radar during the last 18 months of 2026. The public-private partnership model in 2026 is far more integrated into your household financial reality than you likely realize. While you might assume the government is a purely reactive regulator in the insurance space, the reality is a much more proactive strategic collaboration. Federal agencies, driven by the absolute necessity to maintain stability in the housing market and consumer credit sectors, are quietly incentivizing the development of these complex financial products. Imagine the perspective of a senior policy advisor in Washington. They are looking at the massive systemic risk posed by the current housing market trap. They see a nation where millions of households are locked into outdated mortgage rates, unable to move, and where a localized spike in divorce rates could lead to a massive, uncontrollable wave of distressed property liquidations and consumer credit defaults. This is not just a personal tragedy for the families involved. It is a direct threat to the broader stability of the financial system. To prevent this, the federal government is using its vast regulatory reach to clear the path for private firms to provide the very risk mitigation products that the public sector cannot afford to issue itself. This is not a conspiracy. It is a standard practice in modern fiscal governance. Think about how the government handles other complex, multi-sector risks. They use public-private partnerships to manage the expansion of infrastructure, the development of new energy technologies, and even the enhancement of cross-border payment systems. In 2026, the management of demographic risk, specifically the financial impact of marital dissolution on household stability, is being treated with the same pragmatic, partnership-based approach. The government provides the regulatory flexibility, the data access frameworks, and the fiscal policy environment that allows private equity firms to build the infrastructure of relationship stabilization. In return, the private sector absorbs the massive liquidity risks that would otherwise require direct taxpayer-funded bailouts of the mortgage or consumer credit markets. Consider the role of federal agencies in facilitating this. By adjusting the regulatory guidelines for how insurance carriers can utilize anonymized consumer data, the government is essentially creating the digital plumbing for the relationship stabilization market. They are not explicitly mandating the creation of divorce insurance, but they are removing the legislative barriers that prevented it from being actuarially viable a decade ago. They are fostering an environment where predictive modeling, behavioral analytics, and automated intervention protocols are not only legal, but are encouraged as critical components of a modernized, resilient financial system. This is where the distinction between public benefit and private profit becomes dangerously blurred. When a couple like David and Emily, whom we met earlier, receives a subsidized therapy grant or a bridge loan from their insurance carrier, that intervention is a direct result of these public-private synergies. The government is essentially outsourcing its role as a provider of financial stability to private firms. The benefit is clear. The household remains solvent, the mortgage remains paid, and the consumer credit metrics remain stable. But the cost is the total integration of private behavioral data into a corporate-managed ecosystem. The public sector is trading the personal autonomy of its citizens for the systemic stability of its financial architecture. We have to look at the legislative riders and the subtle shifts in federal policy that have enabled this. We are seeing provisions inserted into broader economic security bills that specifically grant insurance carriers enhanced capabilities to access, process, and act upon granular consumer behavioral data for the purpose of risk mitigation. These policies are often framed as consumer-friendly, focusing on the potential for reduced premiums and improved financial outcomes. However, the true objective is the creation of a massive, data-rich ecosystem where relationship risk is as easy to trade as a standard treasury bond. The government is betting that the systemic benefits of this approach, lower foreclosure rates, more stable consumer spending, and reduced pressure on social safety nets, will outweigh the privacy concerns and the potential for corporate overreach. They are calculating that a society of synthetic, corporate-managed marriages is a fair price to pay for a more resilient, predictable financial system. But this is a massive, unprecedented experiment in social engineering. The risks are not just economic, they are structural. What happens when this public-private framework fails to prevent a systemic collapse? What happens when the public realizes the extent to which their most personal life decisions have been financialized for the sake of market stability? The fragility of this setup is becoming increasingly apparent as we analyze the market data in 2026. We are not just looking at a successful model of risk management. We are looking at a system that is becoming exponentially more leveraged, more opaque, and more reliant on the continuous, unbroken performance of its predictive algorithms. The entire house of cards is supported by the assumption that human behavior can be accurately modeled, monitored, and engineered. But as we move into the final phases of our analysis, we have to address the most critical, final variable. The moment the algorithms encounter an event they were never designed to process, leading us into the darkest potential outcome of this entire financial evolution. The most dangerous component of the entire relationship stabilization ecosystem is the reliance on historical data to predict future human behavior. We are building a multi-billion-dollar financial architecture on the assumption that the patterns of the past, captured in millions of anonymized data points, are an accurate map for the future. But 2026 is an era defined by black swan events, rapid technological disruption, and unprecedented societal shifts. What happens when the underlying algorithms, which are optimized for stability and incremental risk reduction, encounter a catastrophic, non-linear event that they were never trained to recognize? Imagine a scenario in mid-2026, where a widespread, highly convincing deepfake campaign, perhaps originating from a hostile foreign actor or a sophisticated domestic group, targets the digital infrastructure of the United States. They do not just target government systems, they target the private financial lives of millions of individuals. They release fabricated evidence of systemic financial infidelity, create illegitimate digital trails of secret accounts and hidden assets, and distribute these assets directly into the private, read-only application programming interfaces that insurance carriers use for risk assessment. The insurance carrier's algorithms, tethered to the private equity firm's derivative risk threshold, would ingest this fraudulent data instantaneously. The models, seeing an explosion of high-risk financial behavior across their entire insured pool, would enter an automated, hard-coded panic state. They would immediately execute their risk mitigation protocols across thousands of households simultaneously. They would freeze bridge loans, trigger mandatory therapy interventions, and automatically increase premiums to astronomical levels. The couple we mentioned earlier, Thomas and Jessica, are suddenly notified that their policy is void due to detected fraudulent financial behavior. Their access to the subsidized bridge loan is revoked precisely when they are already struggling with the economic fallout of Thomas losing his job. They are not the only ones. Millions of households, essentially managed by the same algorithmic infrastructure, are hit by the same automated crisis. The insurance carrier, terrified by the sudden surge of artificial risk indicators, would move to liquidate its exposure. They would stop paying out, cease all support services, and initiate legal proceedings to cancel policies globally, causing an immediate, massive liquidity crisis for the very families they were supposed to be stabilizing. This is the darkest potential outcome of this entire financial evolution. We have created a system that is perfectly optimized for stability under normal conditions, but is incredibly fragile and prone to catastrophic, cascading failure when exposed to abnormal, high-impact events. The systemic risk is not that the insurance companies will fail. The risk is that they will succeed in their primary mission of protecting their own capital, and in doing so, they will trigger a total collapse of the household financial stability they were tasked with maintaining. The fragility is amplified by the interconnected nature of these demographic yield obligations on Wall Street. If the retail insurance carriers suddenly move to liquidate their exposure, the secondary market for these demographic bonds would vanish overnight. The massive pension funds and private equity syndicates holding these assets would see their valuations crater. They would face margin calls, they would be forced to sell off their other, uncorrelated assets to cover their losses, and the localized shock of a few thousand divorces would quickly cascade into a global financial market crisis. The very instrument designed to provide non-correlated yield would become the primary vector for systemic contagion. We must also consider the psychological fallout. We are talking about millions of people who have, over years, effectively outsourced their marital and financial stability to a private corporation. They have become accustomed to the algorithmic nudges, the bridge loans, and the predictive interventions. When that support is abruptly yanked away, the resulting panic and disillusionment would be absolute. The transition from a state of managed synthetic stability to a reality of raw, unfiltered economic and emotional hardship would be instantaneous. The social consequences of such a collapse would ripple far beyond the immediate financial sector. It would fundamentally destroy the public's trust in institutional systems of support, leading to profound long-term social instability. The fragility is baked into the very design of the system. We are attempting to use the tools of finance to solve the problems of the human condition, and we are ignoring the fundamental reality that human relationships are inherently chaotic, unpredictable, and entirely resistant to the logic of a spreadsheet. The attempt to impose order on this chaos, to make it predictable and profitable, is inherently hubristic. It is a classic example of over-optimizing a system until it becomes brittle, where it cannot bend so it must break. As we conclude this analysis, it is clear that the path we are on is unsustainable. The economic data that supports the potential for this market is robust, and the technological capacity to implement it is already here. But the structural, ethical, and systemic risks are equally massive. We are looking at a future where our most personal, intimate relationships are treated as tradable assets, subject to the same algorithmic volatility as a commodity futures contract. The question for every American is not whether this market will grow, but whether we, as a society, are prepared to pay the price for the stability it claims to offer. And that price might be more than just our financial independence. It might be our fundamental agency over our own lives. As we step into the final segment of this masterclass, we will synthesize everything we have learned to answer the most critical question. What does the eventual failure of this market mean for the future of the American dream? The collapse of the divorce insurance market, should it arrive via regulatory intervention or systemic algorithmic failure, will not be a quiet event. It will be a seismic shift that forces a total reevaluation of what constitutes the American dream in the year 2026 and beyond. For decades, the foundational promise of this country has been built on the stability of the middle-class household. We have been told that if you work hard, marry, buy a home, and invest for the future, you will build a sustainable foundation of wealth. The emergence of the relationship stabilization insurance industry was a desperate, market-driven attempt to patch the leaks in that foundation. Its eventual failure will expose the fact that the foundation itself has been fundamentally compromised. Consider the reality for a young couple like Michael and Sarah, who are currently navigating the 2026 economic landscape. They have built their lives on the assumption of dual income efficiency. They have leveraged their combined credit to enter a housing market that would be impenetrable for either of them individually. If the artificial corporate-managed safety net that supports this structural arrangement is suddenly ripped away, the fallout will be immediate and devastating. The potential outcomes are not just financial, they are deeply personal. We will see a massive, forced downsizing as couples who can no longer afford to maintain the fiction of their integrated economic lives are forced to liquidate assets at the worst possible time. The dream of homeownership, once the bedrock of the American middle class, will be further pushed out of reach as the market is flooded with distressed properties, not from traditional foreclosures, but from the sudden forced unwinding of millions of synthetic, leveraged households. The failure of this market will also trigger a profound loss of trust in the institutional systems that we rely on for protection. When the public discovers the degree to which their most intimate decisions were tracked, analyzed, and manipulated to protect the yield of global bondholders, the cynicism will be absolute. We are talking about a total collapse in the perceived legitimacy of the financial services industry. If the institutions that are supposed to manage our risks are instead actively engineering those risks for their own profit, the social contract that holds our society together will be irrevocably broken. Look at the history of financial bubbles and their aftermath. Whether it was the dot-com crash or the housing market collapse of 2008, the damage was never just economic. It was institutional. The American dream was built on the belief in a stable, reliable, and fundamentally fair system. The financialization of the American family unit, and its subsequent potential collapse, will be the ultimate realization of the fear that the system is no longer built for the people it claims to serve. It will serve as a stark, unforgiving reminder that when you commodify the fundamental building blocks of society, you expose them to the brutal, unforgiving forces of market volatility. We have explored the potential for a new paradigm where the household is an enterprise, risk is an asset, and stability is a product. But we must also acknowledge the inherent flaw in this logic. Human beings are not variables in a risk model, and marriages are not business contracts that can be perfectly optimized. The pursuit of such optimization, while financially lucrative in the short term, is fundamentally anti-human. The failure of this market will not be a victory for those who oppose the financialization of our lives. It will be a period of immense, widespread suffering for the millions of people who have been caught in the middle of this grand, failed social experiment. The future of the American dream in the post-market collapse era will require a total pivot. It will necessitate a return to genuine, local, community-based support systems, rather than the hollow, algorithmic safety nets provided by distant global financial institutions. It will require a reevaluation of what actually constitutes wealth. Is wealth a high, non-correlated yield in a portfolio of demographic bonds? Or is it the resilience of a community that can support its members through a crisis without requiring a microloan from a private equity firm? This is the core question that will define the political and economic discourse for the next decade. We have spent this masterclass analyzing the macro and micro trends, the actuarial mathematics, and the systemic risks of divorce insurance. We have seen how the convergence of inflation, high interest rates, and the breakdown of the dual income model created a vacuum that the financial industry was all too eager to fill. We have seen how the intersection of technology and surveillance enabled the creation of synthetic stability, and how the drive for yield on Wall Street incentivized the commodification of our most personal lives. The path forward is not back to the way things were in the 1990s or the early 2000s. That world is gone. The path forward is through a deep, uncomfortable realization that our current model is fundamentally unsustainable. For those of you who have followed this deep dive, the lesson is clear. The financial systems we interact with are not static, neutral entities. They are dynamic, aggressive, and highly innovative, constantly searching for new inefficiencies to exploit and new risks to monetize. Your life, your marriage, and your family are not immune to these forces. They are, in fact, the next frontier. Whether you are a student of market history, an investor seeking to understand the next wave of disruption, or a citizen concerned about the direction of our society, the most critical skill you can develop is the ability to see the patterns that are hiding in plain sight. The data is always telling a story. It is telling us that the systems we rely on are becoming more brittle, more leveraged, and more disconnected from the human realities they are supposed to serve. The question is no longer whether we can build a better financial product to solve our problems. The question is whether we can build a society that does not rely on these financial products for our fundamental security. The American dream was never meant to be a product you purchase, a risk you hedge, or a yield you optimize. It was meant to be a foundation you build, a community you foster, and a legacy you create. If we lose sight of that, we lose everything. The financialization of the family was just the beginning of the story. The true masterclass is learning how to protect your agency in a world that is designed to turn every aspect of your life into a tradable, hedgeable, and optimizable asset. The data shows us the risks. It is up to us to decide what we truly value.